every month the payment has to be made. And this payment, you can have it any day during the month. Suppose a person has opened an account in the month of, say, May, on any day. Suppose 10th of May has opened an account. The next installment he has to pay any day during June. Any day means till the end of the day. So the last day is 30th of June. So that's what we call it is end of the period annuity. So end of the period annuity means the payment or the receipt can be made at the end. And the second one is beginning of the period annuity, that I will explain subsequently. So all deposit schemes, bank deposit scheme falls under the end of the period annuity. So if nothing is mentioned, a bank RD or bank's FD, here this is end of the period annuity. Otherwise, in the question, they will specifically mention a person is receiving at the beginning of a year or at the beginning of a month or beginning of a quarter. If specifically they mention, then it is beginning of the period annuity. Otherwise, all banks deposit is end of the period annuity. There are two formulas here. One is the future value of an annuity. Next is the present value of an annuity. The future value of an annuity, the formula is A by R into 1 plus R the whole raised to minus 1. And present value, it is A by R into 1 plus R the whole raised to minus 1 divided by 1 plus R the whole raised to. Where what is A? The fixed amount which a person is getting or a person is making payment, or we call it the annuity amount. And what is R? The rate of interest. And N, the number of periods. Here you remember the periodicity of the annuity can be monthly, quarterly, half yearly, or yearly. I'll repeat, the periodicity of the annuity can be monthly, quarterly, half yearly, or yearly. In the case of a deposit, a RD, it is an example for monthly annuity. The periodicity is monthly. And if it is monthly, the rate and N undergoes a change. R, you have to divide with 12, and N, you have to multiply with 12. If it is quarterly, R divide with 4, and then multiply with 4. If it is half yearly, R divide with 2, and then multiply with 2. If it is annually, R and N remains the same. Fine. And from this formula, you can calculate even A also. A means the annuity amount. Suppose you are given the future value or the present value and R and N. You can calculate the annuity amount using the formula future value into R divided by 1 plus R the whole raised to minus 1. Now, next is annuity due or beginning of the period annuity. Here, the payment or receipt is made at the beginning. Example is rent. The formula is, these are the two formulas. Already we have discussed present value and future value. And from that also you can calculate. These are all, I'll just skip. Here, EMI, this is, you can expect a question. There will be a loan. It can be a housing loan or a vehicle loan, some loan. And they will say, what is the equated monthly installment? There is a formula. The formula is P into R into 1 plus R the whole raised to n divided by 1 plus R the whole raised to n minus 1. This formula has to be by heart. Here, what is P, R, and N? You should know. P stands for the loan amount, R, the rate of interest, and N, the number of years. Here, the N stands for the number of installment. If it is equated monthly, you have to multiply with 12, and rate you have to divide with 12. That is very important. So that's what half yearly, R by 200, N into 2, monthly, R by 1200, and N into 2. Now we will solve some of these questions. Can I delete this? Okay. Look at the first question. An amount at 10% compound interest becomes 73,205 in 4 years. Find the principal amount. This is a question. 1 second. An amount at 10% compound interest. Remember, if it is just compound interest, the compounding interest is annually. Okay, 1 second. It is annually. So annually means R is 10% and N is 4 years. And what is the 73,205? And an amount becomes 73,205 in 4 years. So this is A. So you have given R, N, and A. What you have to do? You have to calculate P. So what is the formula for compound interest? The formula for compound interest, there is a formula. A is equal to P into 1 plus R the whole raised to. From this formula, you can calculate P. P is equal to A by 1 plus R the whole raised to N. Now you substitute. So P is equal to what is A? 73,205 divided by 1 plus R. 1 plus R. R is 10%. Here it is, nothing is mentioned. That means it is annually compounding. So R means R. So 10% means 10 by 100. And 10 by 100 is 0.1. This raised to N is 4. This is equal to 73,205 divided by 1.1 raised to 4. You simplify it. 73,205 by 1.1 raised to 4. How do you get? 1.1 into 1.1 into 1.1 into 1.1. That is 1.4641. What is the answer you are getting? It is 50,000. Can I go to the next question? Is it clear? No doubt? We'll move on to next question. The population of a town is increasing by 10% every year, and the present population is 5 lakh. Estimate the population 4 years hence. That means here the question is the current population of a town is 5 lakh, and it is given that every year it is increasing by 10%. So you can apply the compound interest formula. So what is the population at the end of 4 years? Every year increasing by 10%. So you can take P as 5 lakh, R as 10%, and N as 4. So the population at the end of 4 years, you will get using the formula A is equal to P into 1 plus R the whole raised to N. P is 5 lakh into 1.1 raised to 4. This is equal to 5 lakh into 1.1 raised to 4. You are getting it as, what is the population? Yes, 4 years hence, 1.1 raised to 4. 1.1 raised to 4 is 1.4641. 1.4641. You multiply, you will get the answer as 73,2056. So 7,32,050. What's the next question? What is the population 3 years ago? That means this thing is given. You have the formula A is equal to P into 1 plus R the whole raised to N. From this formula, this is given. You have to calculate, sorry, A is given. You have to calculate P. P is equal to A by 1 plus R the whole raised to N. So the current population is 5 lakh. So 5 lakh divided by 1.1 raised to 3. 3 years hence. This means 5 lakh divided by 1.331. You'll get it as 3,75,657. Is it clear? I'll repeat the question once again. There is a town and the current population is 5 lakh. You are asked to calculate the population at the end of 4 years. So N is 4 and the rate of increase is 10%. You can take R as 10%. 10% means 10 by 100.1. So use the compound in this formula. You will get the population as 7,32,050. Second question is also estimate the population 3 years ago. So that means you have to calculate P. The A is 5 lakh. What would have been the population 3 years before, 3 years ago? So for that, A by 1 plus R ratio formula you apply, you will get just 3,75,657. We'll move on to the next question. A is investing rupees 5,000 every year for next 5 years at 10%. How much money A gets after 5 years? So here, see, most of the time, the candidate will put to a doubt, dilemma, which formula you have to apply, whether it is a question on annuity or it's a question on compound interest or it's a question on simple interest. That's the confusion students gets. See here, you read the question once again. Wherever there is every year or every month or every half year, something like that, means it is a periodical receipt or payment. That means it's a question of annuity. So here a person is depositing or investing every year 5,000 rupees. So this is a question on annuity. And here, what is the annuity amount? 5,000. So A is 5,000. This is yearly. So the periodicity of the annuity is yearly. And what is N? N is 5. And what is R? R is 10%. So what you have to calculate, how much money A gets after 5 years. That means at the end of 5th year, what is the amount he is going to get? That means you can say that is the future value. Present value and future value. Future value means how much money he is going to get on a future date. And what's the formula for future value? Future value, the formula is A by R into 1 plus R, the whole raised to N minus 1. This is the formula. Substitute, what is A? A is 5,000, the annuity amount, divided by R, 10%. 10% means 10 by 100, 0.1 into 1.1 raised to 5 minus 1. You simplify this, you will get the future value. And the answer for this is 30,525. Fine. We'll move on to next question. I think these are all straight and simple questions. We'll move on to the next question. X would like to receive 10,000 every year for 5 years. How much money X has to invest now if the interest rate is 8%? Again, what is this question? And which formula you have to use? X would like to receive. That means the other one, the person was making a remittance every year. He is making the payment. Here a person is receiving every year. How much? He is receiving 10,000. What is this 10,000? Again, this every is there. Every year means this is a question yearly or every year or monthly. It means it's a question on annuity. So here what is A? A is 10,000. Now what is N? N is 5 year. And what's the rate of interest? R is 8%. These are the given things. What you have to calculate? How much money he has to invest now. So what is that? Is it future value or it is present value? It is present value. In the previous question, it was future value. And for an end of the period annuity, what is the present value? Present value is A by R into 1 plus R, the whole raised to N, minus 1, divided by 1 plus R, the whole raised to N. This is the formula. This is equal to A is 10,000 divided by R, 8%, 8 by 100, 0.08 into 1.08 raised to 5 minus 1 divided by 1.08 raised to 5. You simplify this. On simplification, you will get it as 39,925. That means if a person is depositing 39,925 now, and he is earning an interest of 8%, he gets every year 10,000 for the next 5 years. There it ends. That is the scheme. Clear? We'll move on to the next question. 1 second. Find the EMI of a vehicle loan of rupees 5 lakh at 9% repayable in 7 years. Now, this is a question, a straight question on EMI. EMI stands for Equated Monthly Installment. All of you are familiar because all our retail loans comes under EMI, vehicle loan, housing loan, education loan. These are all, we fix EMI. What is the difference between equal installment and equated installment? In the case of equated monthly installment, the entire repayment has been equally distributed. Whereas in the case of the other one, as number of installment progress, the amount will be less. Here it is equal. So that is equated monthly installment. And there is a formula. What is the formula for EMI? It is P into R into 1 plus R the whole raised to n divided by 1 plus R the whole raised to n minus 1. This is the formula. See, 1 second. EMI is equal to P into R into 1 plus R the whole raised to n divided by 1 plus R the whole raised to n minus 1. Here, what is P? P stands for, P is the loan amount. R stands for the rate of interest. And then the number of installment. Here, what is P? Here, P is 5 lakh. And what is R? 9%. Now, this is the periodicity is monthly. That means R undertakes, this becomes R by 1200. Sorry, 9 by 1200. That gives you how much? 0. What is the value? 0075, I think, isn't it? 0075. And N, 7 years. 7 years means 7 into 12. That means 84. Now you use the formula. EMI is equal to P, 5 lakh, into R, 0.0075 into 1.0075 raised to 84 divided by 1.0075 raised to 84 minus 1. This you simplify. Now the confusion with you is how to get 84th power. I'll repeat, I've already explained in various sessions, but those who are listening to me for the first time, take the base calculator. Scientific calculator is not permitted in the examination hall. So you have to use the basic model of Casio or some other computer and some other calculator. Take the calculator, there you type 1.0075. Type into again 1.0075. Then put the equal sign. You will get an answer. And on the top, there will be a number, either 3 or 003, something like that. Now you keep on put another equal sign. The answer will be changing. And this 3 becomes 4. You keep on tapping the equal sign until here the number becomes 85. So when the number is 85, that is the 84th power of 1.0075. You got it? So what is the answer? 1.0075 raised to 84. Anyone got? This is equal to 3750.
0.8732.
1.8732. Yes, 1.8732 divided by 1.8732 minus 1. You simplify.
8,044.
8,044 or
8,045.
Yes,
Sir,
8,000.
Once again, please tell me that the calculator reason, sir.
Calculator. I'll explain. You have that base model calculator. Some of the
Yes,
calculator it will not function. So I'll repeat it. I will repeat it once again. Now you take the calculator. You type
Yes, sir.
2. Type 2
Yes, sir.
into 2. Put
I didn't
equal
do
sign. Into 2.
Into-
Just 2
Oh,
into
okay,
2.
Oh, okay,
Your
sir.
answer. And on the left hand top, the number is 3 is coming.
Yes, sir.
Now you put one more equal sign, you press.
Yes, sir.
Answer becomes 8.
Yes, sir.
And the 3 becomes 4.
Yes, sir.
Okay, then this calculator will work. Now what you have to do, you don't count. You keep on tapping the equal sign. Keep on tapping the equal sign. If you want 2 raised to 84, you keep on tapping the equal sign until you get 84 on the left hand top. That is the power of 2 raised to 84. Here we want 1.0075 raised to 84. So you erase everything, type in the calculator 1.0075.
Okay,
then
sir.
put the equal, into sign.
Okay,
Again
sir.
1.0075.
Okay, sir.
Then put the equal sign.
Okay,
Then
sir.
keep on tapping. Need not count. If you are very good at counting and each tapping is correct, then you can 1, 2, 3 like that. It's not required. If by fast, because in 10 seconds you can reach 84. Keep on tapping the equal sign and until the left hand top corner, the number digit becomes 85. So if it is 85 means it is 84th power. If you want 120, there should be 121. If you want raised to 72, it should be 70.
1.873.
1.8732. Yes, that's the
Okay.
answer. Okay.
Thank you, sir.
Fine. And remember, in the case of EMI, 2 things you have to remember. Number 1, EMI stands for Equated Monthly Installment. There, the rate you have to divide with 1200 and the number of years you have to multiply with 12. That is an important point before applying the formula P into R into 1 plus R the whole ratio by 1 plus R the whole minus 1. This is understood if it is equated monthly. And remember, the same
Sir,
formula.
I have one doubt, sir. Sir, in case weekly payment, why we have to multiply in 52, sir? Weekly payment.
If
In
it is
case of weekly payment, sir.
weekly payment, I don't think any loan will be weekly. Then you have to.
No, sir. I have a doubt, sir. Weekly payment means we have to multiply in the 52. No. Why
Yes.
we have to multiply in 52, sir?
Because one year comprises of 52 weeks.
Sir, can you tell me briefly, sir?
Pardon? See,
Can you?
one second. Generally, in bank, we don't have weekly payments. All our schemes will be either monthly or quarterly or half yearly or annually. Suppose you wanted specifically the weekly payment. So 1 year means it is 52 weeks. Am I correct? So suppose the loan is to be repaid in 2 years. That means 2 year comprises of 52 into 2, 104 weeks. And suppose the rate is 10%, you have to divide with 5200. 10 by 5200. You get, then you can apply the formula. Understand?
So if it is equated quarterly, what will be the
quarterly? If it is quarterly, I'll come to that. I think there is a look at next question. Let me take the next question. This is something else. Let me complete this and I will explain about quarterly. At the birth of a daughter, a father wishes to invest an amount to accumulate to 5 lakh when the daughter is 18 years old. If the interest he earns on the deposit is 6% compounded semi-annually, how much he should invest now? What is the question? Means whether you have to apply the annuity or you have to use some other formula. Look, whether here the person is depositing every month or every year or every quarter like that. Read the question. At the birth of a daughter, a father wishes to invest an amount to accumulate rupees 5 lakh when the daughter is 18 years old. That means when he wanted this 5 lakh, when the child is 18 years old, isn't it? That means after 18 years. So the time or N is 18 years. And the interest is getting 6%. So what are the given things? Number 1, the rate is 6%, but this is semi-annually or it is half-yearly compounding. And N is 18. So 18 half-yearly means N takes the value 18 into 2, 36. R 6% means half-yearly means it is 6 by 200.03. Am I correct? 0.03. So now you have to use which formula? He is making an on-time payment. He is making an on-time payment. He wanted 5 lakh at the end. So what is how much he has to make? So the formula is A is equal to
Compound interest.
yes, compound interest formula. Here we have to calculate P. P is A by 1 plus R the whole raised to n. What is A? 5 lakh. The future value divided by 1 plus R, 1.03 raised to 36. Simplify, you will get the answer. We'll move on to the next question. Okay. Simplification part I am leaving. It's only pure arithmetic. Effective annualized interest rate. If bank is paying interest at 12%, quarterly rest or monthly rest. This question also they used to ask. What is the annualized interest rate or effective interest rate? There is a formula for this. And the formula is for effective interest rate. The formula is 1 plus R. You can note down effective interest. The formula is 1 plus R the whole raised to n minus 1 into 100. 1 plus R the whole raised to n minus 1 into 100. Now you look at the first part A. Here what is quarterly rest? So quarterly rest means 1 year. How many quarters? 4 quarters. So n takes the value 4. And the rate of interest is 12%. 12% quarterly rest means 12 by 400. You will get 0.03. Am I correct? Now you substitute here. Effective interest 1 plus R 1.03 raised to 4 minus 1 into 100. You will get the answer. What is the answer? 1.03 raised to 14 means 1.03 into 1.03 into 1.03 minus 1 into 100. What's the answer?
12.55.
12.55. Yes. So the effective interest is 12.55%. Now B. What is B? If the compounding rest is monthly. If the compounding rest is monthly, 1 year means n takes the value. How many months for 1 year? 12.
12 months.
And, yes. And R is equal to 12% means 12 by 1200. You will get 0.01. Am I correct? Use the formula 1.01 raised to 12 minus 1 into 100. You will get it as, tell me.
12.68.
68. Good. Is it clear? Clear? Okay. Let me.
Yes, sir.
You wanted that quarterly. I think I have planned a question. Let me see if it is there. Otherwise, I'll explain separately. I think there is a question. This is something else. Okay. After this, I'll explain. Malhotra lent 3,000 to Matthews for a period of 3 years and 5,000 to Thomas for a period of 4 years at simple interest. If he gets a total of 1,450 as interest, find the interest rate. Very simple question, but bit confusing. See, Malhotra lent 3,000 to Matthews. So first amount is 3,000. This is lent for a period of 3 years. And another person, he has lent 5,000. That is for a period of 4 years. And put together from both the persons, he got an amount of 1,450 as interest. And he is charging only simple interest. So 1,450 is the simple interest. What is the rate of interest? This is the question. So see, in simple interest, every year the interest is same. Am I correct? Every year the interest is same. Only in the case of compound interest, interest varies. Because interest earns interest in compound interest. So here it is simple interest. So 3,000 rupees for 3 years or 9,000 rupees for 1 year gets the same interest. Similarly, 5,000 rupees for 4 years or 20,000 rupees for 1 year gets the same interest because 5,000 into 4, that is 20. So you take both to 1 year. So the total amount is 29,000. So amount lent is 29. P is 29. N is 1. I is 1450. Calculate R. R is equal to I into 100 by P into N. I is 1450 into 100 by P, 29,000 into 1. You will get the answer. Is it clear? The logic I'll explain once again. 3,000 for 3 years or 9,000 for 1 year gets the same interest, isn't it? I'll give an example. Suppose the amount is 1,000 rupees and he is getting 10% simple interest. How much interest for 1 year? 100. Second year, he get again 100. Third year, he get 100. So 3-year interest, he get 100 into 300, isn't it? So this 300 rupees interest he gets means for 1,000 rupees for 3 years, isn't it? Similarly, this 3,000 rupees he has lent, and this is for a period of 3 years. This is same as 9,000 rupees for 1 year, 3 into 3,000. That is, so 9,000 into 1, 20,000 for 1 year. So total amount lent is 29,000. You can take P as 29,000, N as 1, and R you have to calculate. I is 1450. So on simplification, you will get the answer as, what is the answer? 5%. Okay, 5%. Okay. I'll explain about the quarterly. You were asking about quarterly. Suppose there is a question. The loan amount, it's not this question. I'll give a question. Suppose the loan amount is 1 lakh and the bank is charging interest at say 8%. And this is to be paid in say 5 years, quarterly installment. Fine. So 5-year quarterly installment. So quarterly means you have to multiply year with 4. So 5 into 4, that means 20. N takes the value 20. And for R, you have to divide with 4 or 400. This you will get 0.02. Now use the formula. EMI, it is EQI. Equated quarterly installment is equal to same formula. P into R into 1 plus R the whole raised to n divided by 1 plus R the whole raised to n minus 1. So P is 1 lakh into R is 0.02 into 1.02 raised to 20 divided by 1.02 raised to 20 minus 1. Suppose it is 5-year half yearly, not quarterly, 5-year half yearly. What is the equated half yearly installment? Question can be asked. Same formula you can use, but the only thing is, what is the difference? R 8% means half year means this goes 8 by 200. Yes, so it is 0.04. And N 5-year means 5 into 2. That is 10. So same formula you can use by appropriately changing R and N. Similarly, there can be a question, equated annual installment. There can be. Not monthly. EMI is equated monthly. Quarterly means EQI. Half yearly means equated half yearly. Or suppose annually, the loan is at 10 lakh is given. That is to be repaid in 5 annual equated annual installment. Then what is the, how to proceed? No change. If it is 8%, R takes 8%. If it is 5-year, N takes the value 5. Straight away, apply the formula. Got it? Okay.
Okay, sir.
Okay. We'll move on to the next one. At certain rate of simple interest, an amount becomes double in 10 years. It will triple in how many years? This is another question. Here, this is not compound interest, it is simple interest. Simple interest, how do you calculate when an amount becomes double? In compound interest, it is 72 by number of years. In simple interest, it is 100 by number of years. That means double in 10 years means rate of interest is 10%. So it will triple in how many years? Double in 10 years, triple in 20 years. So the answer is 20. Got it? I'll repeat once again. At simple interest, an amount becomes double in 10 years. You can calculate the rate of interest. Rate of interest is equal to 100 by the number of years. That means you got the rate of interest at 10%. Now you have to calculate when does at 10% an amount becomes 3 times. How to calculate? We want n. N is equal to I into 100 by P into R. So suppose the amount is X. So you can put X becomes 3X. So what is the interest? Simple interest is 2X, isn't it? So 2X into 100 by P. P is X into R, 10%. X and X get cancelled. You will get the answer as 20 years. We'll move on to the next question. The difference between simple interest and compound interest on certain sum of money at 10% for 3 years is 310. Find the sum of money. Here you have to proceed with, let us assume the amount is 100 rupees. If it is 100 rupees, what is the simple interest for 3 years? Simple interest at 10% for 3 years is P into N into R. P is 100, N is 3, rate is 10%. You will get it as how much? 30. Am I correct? Now, compound interest at 10% for 3 years for 100 rupees. What is the formula? You have a formula. A is equal to P into 1 plus R the whole raised. P is 100 rupees. 1.1 the whole cube. This means 100 into 1.331. You will get 133.10. So what is compound interest? This is the cumulative amount. So the compound interest is 133.1 minus 100, which is 33.10. Am I correct? So 3-year compound interest is 3310 and 3-year simple interest is 30. So what is the difference?
3.1.
The difference between 3.10. So 3.10 is the difference when the principal amount is 100. Here the difference is 310. What will be the principal? How to calculate? For 100 rupees, the difference is 3.1. Then for 310, how much? This is the formula. You will get it as, no, it's not like this. For 3.1, it is 100. Then for 310, how much? Isn't it? This is the formula. You will get it as 10,000 rupees, isn't it? This will be cut. You will get 100. You will get 10,000. Question number 12.
Sir, again,
You want me to repeat? I'll repeat.
yes, sir.
See, you have to assume the amount as 100 rupees.
Okay,
Suppose
sir.
the amount is 100. You calculate 3-year simple interest and 3-year compound interest at 10%. You got simple interest 30 rupees, compound interest 33.10. The difference is 3 rupees 10 paise. So here the difference is 310. The difference between simple and compound interest for 3 years is 310. If the principal is 100 rupees, the difference is 3.10. So for 3.1 rupees, the principal is 100. Then find out for 310. So 100 into 310 divided by 3.1, you will get it as 10,000 rupees.
Okay,
So
sir.
then,
Thank you.
Answer is 10,000. Look at another question. Let me.
Sorry, താഴത്തെ ട്രാൻസ്ക്രിപ്ഷൻ ക്യാൻസൽ ചെയ്യാൻ പറ്റും സാറേ?
What? A would like to get a quarterly payment of 10,000. I'm not able to read this. 1 second. A would like to get a quarterly payment of 10,000 for 5 years. How much money A has to invest now? If A earns interest at 8% at quarterly rest, and you have given PVIFA and PVIFA 2% 20 and PVIFA 8% 5. What is this PVIFA and PVIF?
Present value.
PVIFA only. Whether you are familiarized with this, the term, I'll repeat. PVIFA stands for present value interest factor for an annuity. So PVIFA stands for present value interest factor for an annuity. Here means you need not use the formula. Straight away they have given the answer. So PVIFA 2% 20 means if the rate of interest is 2% and the period is 20 years, then the factor for 1 rupee becomes 16.3504. That is the present value. You're getting me? 1 rupee for a period of 20 years at 2% interest rate. The present value is 16.3504. Means a person is getting 1 rupee for the next 20 years and the rate of interest is 2%. Its present value is 16.3504. And PVIFA 8% 5 means if the rate of interest is 5% and a person is getting 1 rupee for the next 5 years, the present value is 3.9925. Follow? Or the same answer you will get by using the present value of end of the period annuity. What is the formula? Present value formula? It is A by R into 1 plus R, the whole raised to n, minus 1 by
1 divided by 1 plus R raised to n.
Yes, this is the present value. The same formula, you need not apply the formula, the answer is given. Now, what a person wanted 10,000. This factor is for 1 rupee. So if you want 10,000, you have to multiply with 10,000, that's all. And here the thing is, which one you have to take? Whether you have to take PVIFA 2% 20 or PVIFA 8% 5. That is the confusion. Now look at the question. Person wanted it quarterly and for 5 years. So what is N? For a period of 5 years, he should get it quarterly. So what is N? N takes the value?
20, sir. 20.
Yes, 20. And R is 8%. R is 8% means quarterly means R takes the value? 2%. So you have to take the PVIFA 2% 20. Understand? And PVIFA 2% 20 is 16.3504. So if you want 10,000, you multiply this 10,000 with 16.3504. The amount he has to, how much he has to invest now is 10,000 into 16.3504. This you will get it as, how much you will get into 10,000. 1,63,000. Isn't it? 160,504. This is the amount he has to invest.
Sir, 10,000 is annuity amount, right, sir?
10,000 is the annuity amount.
So how to sell more?
10,000 is the annuity amount.
Sir,
See,
we have to use in the
So the
table,
question is
sir.
A into PVIF, right?
PVIFA present value interest factor. Yes, PVIFA where this 10,000 is A. And in this formula, if you are using this formula, from this formula, you have to calculate A. A is equal to PV present value into R by this you will get. And it's something, suppose, okay, you want.
Derive it n equal to 20 and r equal to 2%.
I'll repeat. See, here you have a formula, present value of end of the period annuity. It is A by R into 1 plus R the whole raised to n minus 1 by 1 plus R the whole raised to n. This is the formula. And a person would like to get a quarterly payment of 10,000. That means here, what are the things given? A is 10,000. R is 8%. And it is quarterly, means 8 by 4. It is 2% or it is 0.02. N is, he wanted it for 5 years. 5-year quarterly means 5 into 4, that is 20. Now use this formula. Here we want the present value. If you are not looking at the factor, you apply the formula. 10,000 divided by R 0.02 into 1.02 raised to 20 minus 1 by 1.02 raised to 20. You simplify, you will get the present value. Here that factor is straight away given. The present value of an annuity for 1 rupee is given. We want for 10,000. You multiply this with 10,000. If you simplify, you will get the same answer. And this much step is not required since the factor is given. And you have to multiply, you will get 163,504. Is it clear?
Yes, sir.
Yes, sir.
Now we'll move on to the next chapter, depreciation. This is very important chapter. You can expect minimum 4 to 5 mark question on this. I am not taking much time on the theory part. You must be knowing it. It is a reduction in the value of the fixed asset. It's a process of allocation of expired cost. It is applicable for fixed asset only, and that too for tangible assets. For intangible asset, the term is amortization. Yes. So this is applicable only for fixed asset, and there are various methods. These are all the objectives I'm just leaving. We'll move on to the first method, straight line method. See, under straight line method, the formula is very simple. It is cost of asset minus scrap value divided by useful number of years. So straight line method is also known as fixed rate method. Straight line method or fixed rate method. I'll put it here. Original cost method or fixed percentage method. So the same thing. Here I'll give an example. Suppose there is an asset, fixed asset. Its cost is 1 lakh rupees. So the cost is 1 lakh. This is the cost of an asset. And its scrap value or its salvage value is say 20,000. What is meant by scrap value or salvage value? The value which they get after its useful life when they dispose it of. They get an amount that is called the scrap value. Some question it will be silent. Scrap value will not be given. In that case, you have to take the scrap value as 0. If it is given, you account it. Now, suppose the useful life for this is 5 years. So this is the useful life. And straight line method, depreciation per year, the formula is original cost minus scrap value by useful life. So original cost is 1 lakh minus 20,000 divided by 5 means 80,000 by 5. You will get 16,000. So depreciation per year is 16,000. That means his useful life 5 year means First year depreciation 16,000, second depreciation 16,000, third year 16, fourth year 16, and fifth year also 16. So put together 80,000. So 80,000 they will provide for 5 years, and at the end of 5 years, the book value of the asset will be 20,000, and they will sell it for scrap and realize and make the value of the asset as 0. Okay, so here this amount, cost minus salvage value, is called the depreciable base. Remember, what is depreciable base? The cost minus the scrap value. Fine. And in straight line method, the depreciation amount remains the same throughout. It is constant. It doesn't change. That is the peculiarity of straight line method. And suppose the question will be, in this case, what is the rate of depreciation? Actually, per year, they are providing 16,000 for how much amount? The cost is 1 lakh. So the rate of depreciation is 16%. Am I correct? Because for 1 lakh, they are providing 16,000 per year. So the rate of depreciation under straight line method in this case is 16,000. Suppose the scrap value is not given. That means the scrap value is 0. What will be the rate of depreciation then? Then here 0. So
20,000.
by 5, yes, it is 20,000. The rate of depreciation will be 20%. Okay. Next method.
Sir, one doubt, sir.
Ah.
Sir, just what you said, because the scrap value is given, that also we have to deduct, and out of that only we have to calculate the percentage of depreciation.
Fine. If scrap value is not given, then scrap value you can take it as 0.
Oh.
So the original cost 1 lakh means 1 lakh by 5 means 20,000.
Oh.
So there the rate of depreciation is for 1 lakh you are providing 20,000. That means the rate of depreciation is 20%. In the previous example, you are providing only 16,000. So the rate of depreciation is 16%.
Oh.
Understand? Okay. Now, next is the written down value method. Written down value, this is the method which is recognized by Companies Act and Income Tax Act also. The straight line method is not approved method because as per Companies Act, they says that all companies, they should follow the written down value. The Income Tax Act also says. What is the difference between straight line and written down? In written down value, the rate of depreciation is same, but the depreciation amount keeps on reducing. Because here, the depreciation is calculated on the reduced value. Is it clear? That is what we call it is written down value method or diminishing value method. I will give the same example. Suppose the original cost is 1 lakh and salvage value is 20,000. Here, the rate of depreciation they will give. Suppose the rate of depreciation is 10%. So in written down value method, they will give the rate of depreciation. Whereas in the case of straight line method, either they will give the rate of depreciation or they will give the useful life. And another important point in written down value method is we will not take into account the salvage value or scrap value for computing the depreciation under written down value method. Make it a point. Scrap value is not taken into account. So suppose the rate of interest is 10%. How do you calculate the first year depreciation? First year depreciation is 10% on 1 lakh. How much it is? It is 10%. So what will be the book value? The book value 90%. At the end of first year will be 90,000. Now, second year depreciation is calculated on this 90,000. Means 10% of 90,000. How much? It is 9,000. So what will be the book value at the end of second year? It will be 81,000. And third year, again, 10% of 81,000. That means 8,100. And it goes on like that. This is the difference. So remember, here in written down value method, the depreciation amount is decreasing. But look, the rate of interest is same. It is not changing. Don't get confused. Rate of depreciation is 10%. But this 10% is computing or it is calculating on the reduced amount. Understand? So we can make use of the formula, which is similar to the compound interest. In compound interest, I have given you a formula: A is equal to P into 1 plus R the whole raised to n, where this R is the rate of interest and n number of years and P the principal amount. Same formula you can use for written down value method with a small change. It is 1 minus R the whole raised to n, where P stands for the cost, original cost, R the rate of depreciation, and n the number of years. Why you have put minus? Because in the case of compound interest, interest is added to the principal. In the case of depreciation, the depreciation amount is deducted. That's what we use the formula P into 1 minus R the whole raised to n. This formula also you can use. Is it clear?
Sir, what is depreciated value means?
Yes, that is again, you should have, let me clear this. Here the confusion which students should have, the terms number one, the depreciation amount. You know what is the depreciation amount? What is the depreciation for the first year? Means how much amount you provide for the first year. And suppose the question will be, what is the total depreciation for 5 years? So if the per year is 10,000 and it is straight line method, 5-year depreciation means it is 50,000. So that is with respect to depreciation. So the question may be, what is the first year depreciation, or what is the second year or third year, or what is the depreciation up to the third year? Like that they can have a question. Next is value or written down value or depreciated value. All are one and the same thing. Suppose there is an asset, its original cost is 1 lakh, and you have provided a depreciation of 10,000 first year. So the book value becomes 90,000. Again, suppose you provide 10,000, the book value becomes 80,000. So this is the original cost. This is the book value at the end of first year. This is the book value at the end of second year, and so on. So remember, book value or depreciated value or written down value of an asset means one and the same thing. The value of an asset after accounting depreciation. That is called depreciated value. So the depreciated value, they will ask, what is the depreciated value at the end of third year? Or what is the depreciated value at the beginning of fourth year? Look, at the end of third year and beginning of fourth year means it is the same. As see, your books you are closing as of 31st of March every year, isn't it? So the closing balance of 31st March and the opening balance of 1st April is one and the same thing. Similarly, at the end of third year and beginning of fourth year means same thing. N is 3. End of third year or beginning of fourth year means N is 3, not 4. That you have to be very clear. I think it is okay.
Yes, sir. Clear.
We'll move on to, this is the comparison. I'm not written down value is recognized by Companies Act and Income Tax Act, and scrap value is not taken into account. Whereas in the case of straight line method, it is taken into account. Now, next is units of production method. Units of production method, the formula is actual production divided by expected production during the life into the depreciable days. So here is an example. Suppose there is a machinery, its cost is 40,000 and salvage value is 5,000. So say the cost, let me take. Original cost is 40,000, salvage value is 5,000. So the depreciable base is 35,000. It is estimated to produce 1 lakh bags during its life. That means when the production reaches 1 lakh, they have to sell the machinery for scrap. It is not efficient when the production reaches 1 lakh bags. Therefore, that means in this question, if you want the depreciation as per units of production method, here, what is the depreciation for the first year? So first year depreciation under units of production method, you use the formula. What is the total actual production during the first year? It is given as 10,000 bag. And estimated production, it is 1 lakh. And the base, 35,000. You will get the depreciation as 3,500. Clear? So what you have to do, the formula, apply the formula. What is the total production that you put in the base? Then how much produced during the particular year that you write on the top into the base. Here cost is 40, salvage value 5. So 40 minus 5,000, you will get the base as depreciable base as 35,000. Clear? This is similar to, you can equate to our units of production method and straight line method, more or less same type only, not of much variance. Now, next is sum of the years digit method. Sum of the years digit method, the depreciation is calculated using the formula useful life in years, including that year, into the depreciable base divided by sum of the years digit. This is the formula. I'll give an example. Suppose there is a machinery or a computer, its cost is 50,000 and the salvage value is 5,000. So what is the depreciable base? The depreciable base is 50,000 minus 5,000. You will get it as 45,000. Now the useful life is 5 years. So useful life 5 years means you have to calculate the sum of the years. To get the sum of the years, it is 5 plus 4 plus 3 plus 2. This is equal to how much you will get?
15, sir.
It is 15. So the sum of it, suppose the useful life is 10. What will be the sum? The sum of the digits will be 10 plus 9 plus 8 plus etc. plus 1. Tell me how much it is? It is 55. If the useful life is 8, what will be the sum? 8 plus 7 plus 6 plus etc.
55. 55.
That is 10. If it is 8, it is 28.
36.
36.
Is it 36? Yes, 36. Sorry, it is 36. N into n plus 1 by 2.
N plus 1 by 2.
N into n plus 1 by 2, it is 36. So suppose the useful life is 4 years. What will be the sum? The sum will be 4 plus 3 plus 2 plus 1. That means it is 10. So like that you fix the sum. Then how to calculate the depreciation? For first year depreciation, it will 4 by 10 of the base. This is 3 by 10. This is 2 by 10. This is 1 by 10. Here the question is, useful life is 5 years. So sum you got 15. Now the first year it is 5 by 15. Second year 4 by 15. Third year 3 by 15. Fourth year 2 by 15. And fifth year 1 by 15. This is first year depreciation. This is second year. This is third year. This is fourth year. And this is fifth year. Now, suppose first year depreciation you want under sum of the years. It is 5 by 15 into the base. What is the base? 45,000. You will get the answer.
15,000.
Sir, in this question, we have to find the total depreciation after 5 years, no?
What is the question? Here, compute the depreciation under sum of the years digit method. Useful. Compute the depreciation under sum of the years digit means just an example only. So first year depreciation is 15,000. And secondary, how do you get the secondary depreciation? Secondary depreciation is the factories 4 by 15 into
45,000.
12,000.
12,000.
12,000. And third year, it will
Third year
be
9,000, 6,000,
9,000.
8,000.
fourth year, it will be
6,000.
And the fifth year, it will be
3,000.
So you'll get total 45,000. Isn't it? So this is the method
Yes, sir.
for sum of the year. So these are all the 4 methods which we use for computing depreciation. All the 4 methods are very
Scrap value. So scrap value only for diminishing or decline method is not right. Only
not
this
required.
method.
Yes. Scrap value should not be taken into account for written down value method or diminishing value method.
Only.
All the
Only,
other
right, sir?
methods, all the other 3 methods you can calculate. You can account the scrap value and find out the depreciable base.
Okay,
Okay.
and the scrap value is not given, so it is considered as a zero.
Yes, 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 exactly. Now we'll
Okay.
move on to some of the questions.
Yes, sir.
I purchased a second-hand machinery for 1 lakh on 1st April, spent 20,000 for its overhauling and installation. Depreciation is computed 10% on original cost. On 30th June, the machinery was sold for 75,000. What is the profit or loss in this sale? So such questions they will ask. So here the confusion is, what is the method? Here we have learned 4 methods. Here it is given depreciation is computed at 10% on original cost. Can you tell me what is the method? Is it
So
straight
first,
line?
I think first set line, I guess it is to be used.
Yes,
No?
yes, it is 10% on original cost means
Yeah.
the method is straight line method.
And a scrap
Sometimes
value to be
they
considered
will not give
75,000.
Yes. So now another point, remember, the cost is 1 lakh, but they have spent 20,000 for its installation. So this also to be added. So the original cost becomes 120. So remember, for computing the total cost, you can add the cost of installation, the cost of transportation, and the cost of overhauling. All the things you can add, put together, and that will be the total cost. So here 1 lakh is the cost, second-hand machinery. They spend 20,000 for overhauling, and so the total amount becomes 1,20,000. That means we have to provide depreciation for 120. Here scrap value is not given. So you can take scrap value as 0. That means we have to calculate for 120. Here it is 10% on original cost. So per year depreciation per year will be, tell me, 10% on 120.
12,000.
Yes. So 12,000 is per year depreciation. Now when they have acquired the machine, they have machine acquired on 2017. And when they sold on 36/2020. How many years they have used it? From 1/4/2017 to 36/2020.
3 years, sir.
3 years, only 3 years?
2 months.
3 years and 3 months.
3.25.
2 months, 3 months, isn't it? 30th June. Up to March, full year. Then April, May, June, 3 months. So 3 year and 3 months. Or I can say that 3 and 1/4 year. Am I correct? So per year, 12,000.
Yes,
So what will be the depreciation for 3 and a quarter year?
39,600, sir.
39,000. Yes, 39,000. So 120 is the total cost. Depreciation provided 39. What will be the balance amount in the books of the company? 120 minus 39. 81,000, isn't it? So what is the profit or loss? They sold it for 75. Profit or loss to the company? As per company's
Loss 6,000.
6,000 rupees loss.
1,000, yes, loss of 6.
On the 39,000 calculation, please repeat, sir.
Per year, 12,000. So calculate the depreciation for 3 years and a quarter. For 3 years, 12 into 3, 36,000. And for a quarter, for 3 months, you calculate. If for 1 year it is 12,000, what is for a quarter?
4,000.
3,000.
3,000. That's what 36 plus 3, 39,000. A truck cost 10 lakh and salvage value 1 lakh. It is expected to have a useful life of 1 lakh kilometer and had run 30,000 kilometers in the first year. What is the amount of depreciation at the end of first year? Under either you apply straight line method or units of production, you will get the same answer. If it is straight line method, how to calculate? You find out the depreciable base. What is the depreciable base here?
Cost
Cost 10 lakh.
9 lakhs.
9 lakh. So the depreciable base is 9 lakh. Here the thing is, in the previous questions, they have given the useful life in years. Here it is in kilometer. The useful life is 1 lakh kilometer. That means what? When the truck runs 1 lakh kilometer, they stop it. Then they sell it. So during the first year, 30,000 kilometer it runs. That means for 1 lakh kilometer, you have to provide 9 lakh rupees. So per kilometer, what will be the depreciation amount? Depreciation
9 lakh divided by.
Yes, 9 lakh by 1 lakh means rupees 9. Am I correct?
Yes.
So first year 30,000 it had done. So what will be the depreciation for first year?
Into 30,000.
30,000 into 9, you will get 2,70,000. So this is under straight line method. If you want units of production, again you can apply the same formula. What is units of production method? Total production. Total production is 1 lakh. And first year it is 30,000.
30,000.
The depreciable base.
Depreciable base.
We'll get 2 lakhs 30,000. Both way will get the same answer. Fine. Move on to the next one.
Can you repeat, sir, once again?
See, 10 lakh is the cost. 1 lakh is the salvage value. So the depreciable base is 9 lakhs. That much is clear. Next is the useful life.
Yes, sir.
Here it is given in kilometers, not in years. That means once the truck runs 1 lakh kilometer, they will stop it. Then they will sell it for scrap. Therefore, they have to account this 9 lakh rupees when it runs 1 lakh kilometer. So what is per kilometer? What is the amount to be depreciated? 9 lakh by 1 lakh means 9 rupees. So per kilometer, 9 rupees is the depreciation we provided. First year, it had done 30,000 kilometers. So the depreciation for the first year is 30,000 into 9, 2,70,000. That is under straight line method. If you are using the units of production, what is the formula for units of production? Units of production method says what is the total capacity that you write in the denominator. Here total is 1 lakh, write in the denominator. Numerator, how much they have produced in the first year. Here first year, the truck had run 30,000 kilometers. So numerator, it is 30,000 into the base. Means that also will get you 2,70,000. Okay. Next question. A machinery is having useful life of 5 years. Its original cost is 1 lakh and salvage value is 10,000. What is the amount of depreciation in third year under sum of the years digit method? Also find the depreciated value of the asset at the end of fourth year. Two things they have asked. And here the method is sum of the years digit method. Sum of the years digit method. Here, what is the useful life? Useful life is 5 years. Useful life 5 years means what is the sum? Sum is equal to 5 plus 4 plus, yes, 3 plus 2 plus 1. This is equal to 15. This is first year. This is second year. This is third year. This is fourth year.
Salary value minus salary value we should reduce, no? 1 lakh minus 10,000.
Yes, yes. We have to take. I'm just taking the fraction now. I'm taking
fraction.
Some of the years. So this 5 by 15 of the base is the first year depreciation. 4 by 15 the base is the second year, like that. Now look, the original cost is 1 lakh and the salvage value is 10,000.
10,000.
So the depreciable base is 90,000. Now, what is the question? What is the first question? What is the amount of depreciation in third year? So look at the question. Sometimes the question may be, what is the depreciation up to third year? If the question is, what is the depreciation up to third year, means you have to calculate first year, second year, and third year. Am I correct? So it is 5 by 15 plus 4 by 15 plus 3 by 15. That means 12 by 15. So the fraction will be 12 by 15 of the base. Here, that is not the question. Here, the question is, what is the depreciation in third year? So, in third year means this one. Am I correct? So, third year means 3 by 15. Now,
So, we have to calculate for each and every year, sir. For fifth year, fourth year, third year to second year, first year.
No. Look at the question. What they are asked. If the question is, what is the depreciation up to third year? If that is the question, you have to add the first year, second year, third year. So there you can do in two ways. First one, you calculate for the first year, 5 by 15 into 90,000. Second year, 4 by 15 into 90,000. Third year, 3 by 15, 90,000. Or you can have it in one single calculation, 12 by 15 into 90,000. Am I correct? Because add 5 by 15. That's what I do. Okay. So here it is 3 by 15 of 90,000. Calculate. That will be the first year depreciation. No, that is the third year depreciation. What's the answer? Depreciation, third year depreciation.
18,000, sir.
18,000.
18,000. Yes, it is 18,000. And the next is, what is the depreciated value of the asset at the end of fourth year? What is the depreciated value at the end of fourth year? How to calculate that? You have to calculate up to 4-year depreciation. Means 5 by 15 plus 4 by 15 plus 3 by 15 plus 2 by 15. How much you are getting? 14 by
14 by 15.
84,000.
To 90,000.
This you are getting as, how much you are getting?
84,000.
Yes. This is the, what is this 84,000?
Depreciation value, sir.
Yes, yes, this is the depreciation amount up to 4 years.
Depreciated value is 16,000, sir.
Yes, yes. So the depreciated value of the asset means 1 lakh minus 84, you will get 16,000. Students may get confused. What they will do, they will subtract from 90. It is not correct. Look, the 10,000 scrap value will be in the books of the company until they dispose it off. So the book value or the written down value or the depreciated value means that includes the scrap value also. And so, got it? Therefore, total depreciation provided is 84,000. So the depreciated value of the asset is not 90 minus 84. It is 1 lakh minus 84. That is 16,000. Okay. On to the next question.
14 by 15 into 9,000 or 90,000, sir.
14 by 15 into 90,000 is 90,000. How?
So it's minus to 90,000 or 1 lakh, sir.
That's what I was repeating. You tell me, what is meant by book value? What is meant by book value? What is the value of this particular asset as per the company's register? Am I correct?
Book value is 90,000, right, sir? 1 lakh minus 10,000. Minus
no, book value is not 90,000. Book value, what is 90,000? 90,000 is the depreciable base. That means 90,000 is the amount for which you have to provide depreciation over the 5-year period. It is not the book value. Book value originally it is 1 lakh. The first year depreciation you got 18,000. So what is the book value at the end of first year? In this case, suppose in this case, what is the first year depreciation? First year depreciation is 5 by 15 of 90,000. How much you get?
30,000.
It is 30,000, isn't it? Is it 30,000? 90,000 by 15. How much you are getting? 4,500. Is no.
90,000 divided by 3.
30,000. You are getting this as 30,000, isn't it? So first year depreciation is 30,000. So what is the book value at the end of first year?
20.
No.
70,000.
70,000.
70,000.
Is it 70 or 60?
70.
It is 70 because from 1 lakh you have to minus 30,000. It is 70. That's what. This is the confusion you have. I know that. Remember, the depreciation is provided for the base after accounting the salvage value. But to get the book value, you have to add the salvage value also. Isn't it? Because the salvage value will be realized only when they dispose of the assets. Now this asset is in the books of the company. So in the books of the company, this salvage value is also there. Understand? Okay. The next question.
Okay, sir. Understood, sir.
Okay. This people, I know, every session, some of the participants will have a doubt on this area.
Sir, one query regarding scrap value. Which method use scrap value and which is not?
For written down value method, scrap value is not taken into account. For all other 3 methods, scrap value is taken into account.
Thank you, sir.
Now, the next is the book value of a machinery after 3 years of its use is 51,200. What is the original cost of the machinery if the firm compute depreciation under written down value method at 20%? So here the method is written down value method. And here the formula is, there is a formula A is equal to P into 1 minus R the whole raised to n, where or I can put the book value is equal to original cost into 1 minus R the whole raised to n. Am I correct? A stands for the book value. Book value is equal to original cost into 1 minus R the whole raised to n. What is the question here? We want original cost. So original cost is equal to book value by 1 minus R the whole raised to n. What is the book value? It is given that the book value of the machinery after 3 years is 51,000.
1,200.
The rate of interest is 8%. So 1 minus 2 and number of years is 3. Sorry, 1 minus 0.2. 1 minus 0.2. This is equal to 51,200 by 1 minus 0.2 is 0.8 the whole cube. 0.8 the whole cube. Calculated. This is 51,200 by 0.512. What is the answer?
1 lakh.
Yes. Clear? Okay. Next
The
question.
rate of interest is 20% only, no, sir.
It is given 20%. That's what 20% means 20 by 100. R is 0.2. So 1 minus R means 1 minus 0.2. And 1 minus 0.2 is 0.8.
Okay, sir. Okay, sir. Thank you.
Sir, 1 lakh or sir?
Pardon? 1 lakh. 1 lakh. Answer is
1 lakh.
Yes, yes.
1 lakh. 1 lakh and 392. To be more exactly.
Foreign exchange.
Exact 1 lakh. Not 392.
Exact 1 lakh. Instead of 392 kittanunde. 1 lakh 392 kittanunde.
No. I'll repeat it. See, the formula is we want P. P is equal to A by 1 minus R the whole raised to n. Am I correct? What is A?
Okay.
51,200.
51,200.
1 minus 0.2 the whole raised to 3. This is 51,200 by 0.8 raised to 3. This is 51,200 by 0.512. Okay.
Sir, foreign exchange.
Foreign exchange. Okay, I'll take it. This is enough.
The bond value, sir.
Bond also required. Let me.
Bond is very important, sir.
So
There
bond
is
is
a lot of
very
confusion. Confusion is there.
Confusion is there. I know that. We'll straight away go to the question. A bond of face value 1,000 bears a coupon rate of 10%, has a maturity period of 3 years. What is the value of the bond if the required rate is 12%? Also compute the value of the bond if the required rate is 8%. Such questions they will ask. See, what is the value of the bond? So here, how to calculate the value of the bond? The value of a bond is calculated by computing the future value, future cash flow into present value table. That is the thing. Here, look, there is a bond. The face value is 1,000 rupees. So here, face value is 1,000. 10%.
Yeah.
Please mute.
Please mute all members.
Please mute. Now, what you have to do? You have to write the cash flows. Maturity period 3 years means first year, second year, third year. And next is the cash flow. How much he gets for the first year? Coupon rate is 10%. Value is 100 rupees. So at the end of first, if a person invests in this bond, at the end of first year, he gets 100 rupees. No doubt. At the end of second year, again, he gets 100 rupees. And at the end of third year, how much he gets? He gets 100 rupees, the coupon, plus the face value 1,000, put together 1,100. Is it clear? Is it clear? So this is the future cash flows. Am I correct? A person who purchases a bond now for 1,000 rupees, he has to wait for 1 year, he get 100 rupees as interest. And again, after 1 more year, That means at the end of second year, he gets another 100. And at the end of third year, he get the 1,000 rupees plus 100, 1,100. Now, to calculate the present value, you have to find out the present value of this cash flows. And what is the rate? Here, what is the rate? The required rate. What is the required rate? Find the value of the bond if the required rate is 12%. So you have to calculate the present value at 12% or find the discounted value of 100 rupees. What is the present value of 100 rupees you are getting after 1 year at 12%? The formula is, what is the formula? Present value is equal to future value by 1 plus R, the whole raised to n. Here, what is R? 12%, and what is n? 1. So what is the future value? Is 100 rupees. So present value is equal to 100 by 1.12. Now, next 100 you are getting after 2 years. So its present value is 100 by 1.12 square. And this is getting after third year. So it is 1,100 by 1.12 the whole cube. You calculate this and add it. That is the value of the bond at 12%. You will get it as 951.97. Next question is, what is the value of the bond if the required rate is 8%? If the required rate is 8%, means you have to discount at 8%. So it will be 100 by 1.08. This is 100 by 1.08 square. This is 1,100 by 1.08 cube. You calculate and sum it. You will get it as 1,051.54. This is the way to calculate the present value or the value of a bond. Is it clear? What you have to do? You have to find out the future cash flows, convert it into the present value by applying the discount factor at the required rate. If it is 12%, you can compute the present value at 12% discount. If it is 8%, compute at 8%. Okay. Now, we'll move on to the next one. You will be given, find the modified duration, where the duration is given. This is a very simple question. See, the formula is modified duration is equal to duration by 1 plus y by n. Here, duration is given. Duration is 2.5. And YTM is 6%. So 1.06. You will get the answer. Where what is n? N stands for the number of coupon payment in a year. Or I will put it in another way. If the coupon payment is annually, n is 1. If the coupon payment is half yearly, n is 2. If the coupon payment is quarterly, n is 4. Clear? Suppose the question is, you find the modified duration. If the duration is 2.5 and YTM is 6%, coupon payment semi-annually. That means you can take n as 2. Understand? So here, nothing is mentioned. That means it is annual payment. Therefore, n is 1. So 2.5 by 1.06 is the answer. What is the answer? 2.5 by 1.06? 2.36. The answer is 2.36. Now, next question is, what is the a bond of face value? A bond of face value, 1 second, 100, carrying a coupon rate of 12%, is traded in the market at 90. What is the current yield? There is a formula for current yield. The formula is current yield is equal to coupon amount into 100 by the market value. Here, what is the coupon amount? 100 rupees is the face value. 12 rupees is the coupon rate. So the coupon amount is 12 into 100 by the market value is 90. You will get the answer as, what is the answer? 13.33. Question number 4. Current price of a bond is 98.50. its duration is 2.7613 years. So the price, current price, or the market price is 90.50, and its duration is 2.7613. If the yield is likely to change from 6 to 5.8, what is the percentage change in the price of the bond? Also find the revised price of the bond. Such a question also they can ask. So here there is a formula, percentage change in price of a bond is equal to minus modified duration into percentage change in yield. So here duration is given. You have to calculate the modified duration. How to get modified duration? Modified duration is equal to duration by 1 plus pi by n. What is duration? 2.7613 divided by 1 plus yield is 6%. 6% means 6 by 100. 6 by 100 is 0.06. Simplified, 2.7613 by 1.06, you will get it as 2.605. Apply the formula, minus 2.605 into percentage change in yield. What is the percentage change in yield? From 6 to 5.8. 6 to 5.8. 6 from 6, it moves to 5.8. That means it is a reduction by 0.2%. So since it is a reduction, put a minus sign, 0.20. This on simplification, minus into minus becomes plus. 2.605 into 0.2 gets you how much? 0.521%. So the first answer is the change in price is 0.521%. What is the next question? Also find the revised price. How to get the revised price? Revised price, you have to the original current price is 98.50. So revised price is equal to 98.50 plus 0.521% of 98.50. How to get it? 0.521% of 98.50. This is equal to 98.50 plus 0.521 into 98.5 by 100. You will get it as 98.50 plus 0.51. And the answer is 99.0. Okay. I think it is saturated. Some of the candidates have already left. Shall I proceed further? Price of an 8% bond with face value 100 is depreciated to 99.8. What is the current yield and how much is the yield changed? See, 8% bond, face value 100. So here the price of 8% bond with face value 100 is depreciated to 99.80. What is the current yield? How to get the current yield? Current yield is equal to coupon amount into 100 by market value. What is the coupon amount? Face value 100, coupon rate 8%. Is 8. Pardon?
Sorry, sir.
Divided by 99.80. Based on simplification, you will get us 8.016%. So you got the current yield as 8.016. Earlier, the yield was 8%. From 8%, it moved to 8.016%. Now the question is, how many basis points the yield changed? How to calculate the basis points? What is the relationship? 1% is equal to 100 basis points. So here the yield is changed by 0.016%. How many basis points? 0.016.
Coupon amount is 8, sir.
Yes. 1.6 basis point. Look at the question. It is 8% bond. What is 8% bond? Price of 8% bond means the coupon rate is 8% and the face value is 100. So if the coupon rate is 8% and face value is 100, what is the coupon amount? 8% of 100, that is 8 rupees. Isn't it? I have applied the formula only. Current yield, the formula is coupon amount into 100 by market value. Here one important point to remember is that coupon is payable on the face value, not on the market value. Remember, the coupon amount is payable on the face value because who is paying the coupon amount? The company which had issued the bond is paying the coupon amount. And for them, in their books, it is the face value. And what is market value? It is either in the market, sometimes above the face value, sometimes below the face value. If it is above the face value, we say that the bond is traded at a premium. If it is below the face value, we say that the bond is traded at a discount. So that the company is not bothered at all. Market value depends on the interest factor. If the ruling interest is less, the value will be more. If the ruling interest is high, the value will be less. Because in the case of bond, the interest rate and value are indirectly or inversely proportional. When one moves up, the other will come down. If interest rate in the market, interest rate moves up, value will come down. If the market interest comes down, the value of the bond will move up, increase. Isn't it?
Sir, depreciated to 99.8 in the market value on 99.8 in the
Yes. Depreciate. The face value is 100. That is depreciated to 99.8 means the value of the bond has reduced to 99.8. So the market value is 99.8. Earlier it was 100 rupees. That has reduced 99.80. So what is the change in current yield? That is a question. What is the current yield and how much basis point it is changed? So you have to calculate the current yield. Current yield, the formula is coupon amount in 100 by market value. You got it as 8.06. So earlier the yield was 8, that has moved to 8.06. So there is an increase of 0.016%. And if you want to convert to basis point, multiply with 100. So 0.16 into 100 is 1.6 basis point. So the yield has increased by 1.6 basis points. Okay.
Sir, the current yield to maturity in the
current yield means the yield which they are getting now. Yield to maturity means the aggregate yield they get if they hold it till it's matured. Suppose this bond, the maturity is 5 years. They hold it for 5 years. And at the end of 5 years, what is the average yield he is expected to get? That is known as the YTM or yield to maturity.
Same way, modified duration and duration.
More duration is the holding period for break even. Duration is the holding period for break even. Or I'll put it in another way. See, a bond, a person has to, the investor, how long he has to hold so that the fluctuation in interest rate is not affected. The investor doesn't have the interest rate risk. That holding period is called duration. Is it clear? So duration, I can say duration is the break even, or duration is the holding period for which the investor is not affected by the interest variation in the market. You may not understand it now because it's a little bit confusing term. I'll put it in another way. See, suppose there is a bond. Its face value is 100 rupees and the coupon rate is 10%. Now the market rate moved to 12%. What will be the value of the bond? Look at, see, what is coupon rate? Any person who invests in this bond will get a return of 10%. Am I correct? And what is the market interest rate? Ruling interest rate. That means the interest rate has moved from 10 to 12 because this company might have issued this bond some 1 or 2 years back. That time the prevailing rate may be around 10%. That's why the company had issued this bond at 10% and people have subscribed to that or they have invested in this bond. And the interest rate in the market is not static. You must be knowing. Now see, look, some 10-year back, the interest rate in the banking system, it was around 8 or 9 or 10%. Now, gradually, the interest rate has reduced. Presently, for 1-year deposit, you pay 6% or 5.5%. Am I correct? There is a reduction in the market price. That's what. So here, the coupon rate is 10%. Now, the market rate has increased. That means, suppose a person wanted to invest, he gets 12% return. Am I correct? So will he buy this bond? It is giving 10% return. He will not go this bond. And if in turn he wanted to buy, he will say, give me this bond at 90 rupees. I will buy it. Am I correct? That's what, when the market rate or ruling rate or required rate or current interest rate or the prevailing rate is above the coupon rate, the value of the bond will be at a discount or it will be below the face value. Now look, the next situation, coupon rate is 10%. The market rate is 8%. That means if a person has got some money, if he invests in the bond, he get 10%. If he invests in some other area, he will get only 8%. Am I correct? So there will be a lot of people in the queue to buy this bond. So the seller of the bond, what he will do? Give me more. I will not sell at 100, give me more. So this bond will be traded at 120. So that's the thing. So this is the theorem which you have learned in your in the initial classes. That means this value and the market rate are inversely proportional. If the market rate is above the coupon rate, means the market rate is more than the coupon rate, value will be less than the face value. And if the market rate is below the coupon rate, the value will be above the face value. That is what a theorem. The interest rate and the value are inversely proportional. If the interest rate in the market is moving up, value will come down. If the interest rate in the market is coming down, the value will move up. So this is the situation. And what is the duration? Duration means suppose a person has purchased this bond. It's a maturity period is 5 years. And what is the holding period for which he is not affected by the fluctuation in the market rate? That is called duration. It may be below the maturity period. It may be 2.5 years or 3 years or 3.5 years. That for duration, calculating duration, there is a formula. It is sigma PV into T by sigma PV. This is the formula for duration, or it is also known as Macaulay duration, because the Macaulay, the economist, is the Frederick Macaulay has invented, or he has formulated the concept of duration. Now, next is modified duration. What is modified duration? Modified duration refers to the change in the value with respect to a change of 1% in the yield. How much the value will change for 1% change in the yield? That number is called a modified duration. So that is a number. Duration is always in years. And this modified duration is a digit, or you can say it's a ratio. How much, when the yield is changed by 1%, how much value changes? That is called the modified duration. Okay.
Yes, sir.
Sir?
Yes.
Sir, I have a query with respect to bills of exchange and promissory notes.
Pardon?
Bills of exchange and promissory notes, sir. In bills of exchange, accepted by debtor is necessary or not, sir?
Audible, because some disturbance was there. Can you repeat it once again?
Sir, in bills of exchange, acceptance by debtor is necessary or not, sir?
Bills of exchange. You're referring to bills of exchange. That's not pertaining to this topic, bills of exchange. No, it's not there in A module.
Before you wind up the session, I just want to clarify, sir. That's why I asked.
Yes, bill of exchange.
Not familiar with this bill of exchange. Okay,
sir.
See, a bond with remaining maturity of 4 years and present value 8% has modified duration 3.5. find its Macaulay duration. So this question also they can ask. See here, you have to use the formula modified duration is equal to duration by 1 plus y by n. From this formula, you can calculate duration. What is duration? This will be modified duration into 1 plus y by n. Now here in the question, you have given modified duration. Modified duration is 3.5. And you are given the yield. The yield is 8%. So what is duration? Duration is equal to 3.5 into 1 plus y. 8% means 0.08. This is 3.5 into 1.08. You'll get the answer as 3.78. Second part is also find the Macaulay duration if the coupon is payable at 8% semi-annually. So here the coupon payment is semi-annually. So semi-annually means n takes the value 2. So the formula, it is 3.5 into 1 plus y by 2. Y is 8%. So 8 by 2 means 0.04. So this is 3.5 into 1.04. You will get the answer as 3.64. So the duration is 3.64 in the second case and 3.78.
First case, the N is 4 years, sir.
Pardon?
In first case, maturity of 4 years, it is equal to N, sir.
First case, it is not like that. See, the remaining maturity of 4 years, the 4 years we are not taking into account. Here you have to look at the yield and the duration, modified duration. Here the question is, you have to calculate the duration. You are given the modified duration and the yield. The 4 year, it is nothing. You need not take into account the 4 year here. Here, because the formula is modified duration is equal to duration by 1 plus y by n. And here, what is modified duration? 3.5. And what is yield? 8%. So 8% means if nothing is mentioned, it means the coupon is payable annually. If the coupon is payable annually, n is 1. So 3.5 into 1.08. You will get the answer. And second situation is coupon is payable half yearly. Semi-annually means half yearly. If coupon is payable half yearly, n takes the value 2. So 8% means 8 by 2. 8 by 2 is 4%. That means 0.04. So it is 3.5 into 1.04. You will get it as 3.64.
So we don't want to change n there.
N represents the periodicity of coupon payment. If annually coupon, n is 1. If the coupon payment is half yearly or semi-annually, n is 2. If the coupon payment is quarterly, n is 4.
It is 104 by 2 will come now.
8 by 2. 8 by 2 is 4. That's what in the second part I have put 3.5 into 1.04. Isn't it? Y by n. Y by n yield is 8%. 8%, what is 8%? 8 by 100. 8 by 100 is 0.08. That's what here it is 0.08. 1 plus 0.08. This is the formula. 1 plus y by n. And here n is 2. Yield is 8%. So n is 2 means 8 by 2. 8 by 2 is 4. So it is 4%. 4% means 4 by 100. 4 by 100 is 0.04. That's what here it is 1.04. Okay. I think we'll wind up here. Now it is 10:15. You have to go for the
Thank you, sir. Thank you so much.
Sir, one more query, sir.
What is the query?
Foreign exchange, sir.
Foreign exchange. Just briefly explain.
Yes, yes. See,
Sir,
there are
one more doubt, sir. Sir,
What is it?
in imports, exports is buying transaction for bank, whereas in imports it is selling transaction for bank, and
Yes, exactly.
buying transaction for customers or what, sir?
Yes, yes.
In imports,
It's a
buying
valid
transaction for customers.
doubt. I'll explain. See, there are two types of transaction. One is buying, another is selling. For a buying transaction, bank applies the buying rate. Buying rate is also known as bid rate. For a selling transaction, bank apply the selling rate. Selling rate is also known as offer rate or ask rate. Now, how to differentiate a buying and a selling? Here, you have to look at the banker's point of view. So bank applies the buying rate if bank buys foreign exchange. Bank buys foreign exchange means bank buys a foreign currency from the customer. If bank is buying for the customer, it is a sale. Is it clear? So when bank gets foreign exchange, it is a buying transaction. Or when customer gives foreign exchange to the bank and in turn gets Indian rupee, it is a buying transaction for the bank. I will give an example. There is an exporter. Okay, an exporter. What is happening in export? In export, the goods goes out of India and the value will come in the form of foreign exchange into India. Suppose the person is exporting to, say, Dubai. He is exporting garments to Dubai. He is exporting garments to Dubai, and in turn from Dubai, the price in the form of, say, UAE dirhams is getting. So he is getting foreign exchange. The exporter is getting foreign exchange in dirhams. And this UAE dirhams is handing over to the bank. And in turn, bank has to give him Indian rupee. So when bank gets foreign currency and bank gives Indian rupee, it is a buying transaction. Correct? Or you can put it in another way. In a buying transaction, customer account is credited. In a selling transaction, customer account will be debited. And in sale, what is happening? Bank is giving foreign exchange to the customer. And in turn, customer is paying Indian rupee to the bank. Or I can say, in a selling transaction, bank gives foreign exchange and bank gets Indian rupee. Or customer gets foreign exchange and customer gives Indian rupee to the bank. Is it clear? Is it clear? And all export transaction, it is buying. All import transaction, for the bank, it is selling. There are 4 types of transaction: cash or ready, term, spot, and forward. You must be knowing it. If the date of settlement is on the same day, it is cash or ready transaction. If the settlement takes place on the next working day in both the countries, it is term. It is on the second working day in both the countries, it is spot. If it is beyond second working day, it is forward. That is clear. So here, remember, it is next working day. The question will be put in such a way that intervening holiday will be there. For example, the national holidays are December 25, October 2, August 15, and January 26. The question will be on January 24, a deal has stuck. So the transaction emanated or the date of contract is January 24. This is, say, Wednesday. The question will be like that. And they settled it on January 24, 25, 26, 29. What will be the transaction? They may ask the question like that, whether it is cash, term, spot, or forward. So you have to look into when the settlement takes place. What is settlement? The exchange of currencies or the completion. See, in the case of foreign exchange, the settlement is not possible to take place on the same day because of the time zone difference. Because one person will be in India and the counterparty will be either in Japan or in Germany or in Australia or in US. So there is a difference. If now here it is 10:15 night, it will be morning in US because there is a difference of 11 hours. They are behind us. Remember, so therefore it is not possible to settle immediately. That's what there is a gap. And that's what we say classify into cash or term or spot and forward. A question they will ask. Next is quotation, direct quotation. Direct quotation means $1 is equal to how many Indian rupees, or €1 is equal to how many Indian rupees. This is a direct quotation. Direct quotation, the principle is buy low, sell high. Direct quotation is also known as home currency quotation or price quotation. Next is indirect quotation. In indirect quotation, it is the other way. 1 Indian rupee is equal to so much foreign currency, or 1 Indian rupee is equal to so much euro. This is indirect quotation. There the principle is buy high, sell low. It is also known as foreign currency quotation. And the relation is direct rate is equal to the reciprocal of indirect rate, or indirect rate is the reciprocal of direct rate. So the question they used to ask, what is the principle in direct quote? Buy low, sell high. In indirect quote, it is buy high, sell low. That is the then forward rate that will be at a premium and discount. To get the forward rate, you have to add the premium to the spot rate. To if the currency is at a discount, you have to subtract from the spot rate. And how to decide whether a currency is at a premium or discount? Look at the forward points. If the forward points are in the ascending order, then the currency is at a premium. Look at, see, 510. 510, the forward points, 5, it is increasing. That means it is ascending. Means the currency is at a premium. In the other case, it is second case, 10, the forward points 10/5 paise. That means it is descending. That means the currency is at a discount. Then is cross rate mechanism. Now it is not. You want me to explain all those things? I'll do this example. Given that spot euro is equal to USD 1.245070. That means 1 euro, or here the rate is euro USD is 1.245070. And the forward points, 1 month 2018, 2 month 4038, 3 month 7572. You have to calculate the forward rate for a sale, 2-month sale, forward sale by bank. How to calculate the forward rate? Now, first you look at the forward points. This is all in points. 2018, 4038, 7572. Whether they are in ascending or in descending, they are in descending. They are in descending means they are at a discount. So how to get the forward rate? The forward rate is equal to, if the currency is at a discount, it is spot rate minus the discount. Am I correct? And here the first question, A, is what is the forward sale, selling rate? We want the selling rate. So selling rate means you take the spot selling rate minus the discount for selling rate. Now this is equal to, what is the spot selling rate? Here, if the rate is given like this, the first rate is the buying rate, second rate is the selling rate. So the spot selling rate is 1.2470, the second rate. Am I correct? Minus, now the discount. See, 1 month. Again, here you have to look, there is a guideline. When a currency is at a discount and you want a selling rate, when the currency is at a discount, if you want the selling rate, you have to allow the discount up to the previous month. So 2 month means you have to get the discount for 1 month minus 1 month discount. That is equal to 1.2470 minus what is 1 month? 1 month, this is the discount. Here, this is for buying and this is for selling. So selling is 18 and 18 is in 2 decimal. You have to write to 4 decimal. It is 0.0018. This will be 1.2452. Is it clear? I'll repeat once again. One point to remember is when the forward points are given in points 2018, that means you have to convert it to 4 decimal. Sometimes it will be in paise where the rate will be dollar in terms of Indian rupee. Then suppose it is 2018 paise, then you can take it as 0.2 and 0.18 because 20 paise in rupee it is 0.2. Here it is in forward points, and the currency is expressed euro in terms of dollar. So it is nowhere Indian rupee. So paise is not there. So you have to make it 4 decimal. And another point is, when the currency is at a discount, you have to pass on the discount in the selling transaction up to the previous month, and in a buying transaction up to that month.
In case of
premium, for a buying transaction up to the previous month, and for a selling transaction up to that month. That's what
question.
Look at this table. This table will be of more useful if you understand the concept. At the bottom, delivery period in month, and when the currency is at a premium. For buying, add premium up to the previous month, and selling up to the same month. The only thing is this much. We are following the direct quotation, and in direct quotation, it is buy low, sell high. When we buy at a lower rate. So when the currency is at a premium, means that as the day passes, the value of the currency is moving up, going up, and we will not pass on the higher value. That is the thing. So that is the concept. Okay. Now,
sir, one doubt, sir. Discount buying rate
discount. See, this we will go to the second question. 3-month forward buying rate we want. 3-month forward buying rate. So for that, we have to take the spot buying rate. What is the spot buying rate?
1.2450.
2450. Fine. Now look at the currency is at a discount and the transaction is a buying. When the currency is at a discount and the transaction is buying, you have to allow the discount up to that month. So 3 months means 3 months. And 3 months, what is the buying points? The first is the buying points.
0.075.
First is 75. So it is 0.0075. You subtract. Understand?
Yes, sir.
So 5.
Sir, this question le avasanam buy bank nu thannillengilo.
Then it will be the other way. At what rate it can be sold? There is a question. There is a question. I'll explain that also. Look at this question. What is the rupee equivalent? 70. Here, the cross rate mechanism. We have 2 rates. One is USD INR 72.5055 and GBP USD 1.237075. We have to calculate GBP INR. This is cross rate mechanism. Because you have 2 rates. What does this rate says? $1, how many Indian rupee? What does this rate says? 1 GBP, how many dollar? We want 1 GBP, how many Indian rupee? This quote is not directly available. That means we have to use the cross rate mechanism. In cross rate mechanism, there are 2 rules. Here, the common currency is dollar. This is on the opposite side. When the common currency is on the opposite side, to get GBP INR, you have to multiply 1 with 2. If you want buying rates, it is product of buying rate of 1 into buying rate of 2. Similarly, if you want selling rate, it is selling rate of 1 into selling rate of 2. So in the first case, an export bill. Export bill means we want the buying rate. And how to get the buying rate? First equation, what is the buying rate? 72.50. And second equation, what is the buying rate? 1.2370. This will be the rate for GBP. Similarly, import transaction, we want the selling rate. How to get the selling rate? First equation, selling rate 72.55. In second equation, selling rate 1.2375. You simplify, that will be the selling rate. And you can calculate the rupee equivalent. We'll move on to the next question. In London market, USD and Euro rate is 1 USD is equal to 0.90 euro. In Mumbai market, 1 USD is equal to 72.50 Indian rupee. Compute Euro INR. So we want Euro INR rate. What is available? One is USD Euro. USD Euro is 0.90. Next is USD INR. It is 72.50. Equation 1, equation 2. Here also it is cross rate mechanism. But remember, here the common currency is dollar, is on the same side. In the previous slide, the common currency was on the opposite side. Remember, isn't it? In the first equation, it is in the numerator. Second equation, it is in the denominator. But here it is not so. Dollar is on the same side. If the dollar is on the same side, the rule is not multiplication. The rule is division. Division of opposite side. So here, the Indian rupee rate is the second one. So here you have to divide 2 with 1. And 2 with 1 means what is 2? 72.50 by 1 is 0.90. This will be the value of euro in terms of INR. Understand? You can solve it. That will be the rate of euro in terms of INR. Next is...
why we are dividing 2 by 1?
Because that is the rule. If you multiply, you will not get. Because see, in the previous question, why do you multiply?
It is 1 by 2. How in what order?
It is equation number. Equation number. It is.
USD INR. This is GBP by USD. USD gets cancelled. You will get GBP by INR. That is why we have multiplied it. But that is a thumb rule. Here, multiplication will not get cancelled. So here you have to divide 2 with 1. If you divide 2 with 1, this is USD by Euro divided by, the 2 by 1 means USD by INR divided by USD by Euro. This reduces to USD by INR into reciprocal of second. Euro by USD. USD get cancelled. You will get Euro by INR. That is why we divide it.
Sir, same question. The buying rate and selling rate separately.
Common here it is. If you want the buying rate, if you are interested, I will go for this cross rate mechanism. This is the rule. Situation 1, the rule is multiplication of same side. And situation 2, common side, common currency, same side, it is division of opposite side. That means if you want the buying rate, it is buying rate divided by selling rate. If it is selling rate by buying rate. I will explain. I will give an example. Suppose you have given USD INR, say 74.5060, and you have given another rate USD SGD. USD SGD is equal to 1.2526. This is equation 1. This is equation 2. Now, common currency is on the same side. So look at the rule. The rule is division. It is division of opposite side. Remember, whether it is 1 by 2 or 2 by 1, that you have to fix. If you want SGD by INR, it should be 1 by 2. So 1 by 2 is the rule. We have fixed. And if you want the buying rate of SGD, means buying rate of 1 divided by selling rate of 2. That means what is buying rate of 1? 74.50 by selling rate of 2, 1.26. Similarly, if you want the selling rate of SGD, Singapore dollar, numerator, selling rate of 1, denominator, buying rate of 2. That means what is selling rate of 1? 74.60 by 1.25. Clear? You simplify it. We'll get the answer.
When we have to take this.
Yes, and now for simplicity, I have put this 2 decimal because you have to, as per FEDE guidelines, you have to round it off to 4 decimals. 4 decimals, and the third and fourth decimal should be multiple of
No. Sometimes we are taking for with 4 decimal points now, but sometimes we are doing with 2 decimal points.
That depends on the question. No, in some question they will give you with 4 decimal. Here in this question, look, they have given 4 decimal, and we have here no rounding off also can be. Here you have to round off. Here you have to round off. You calculate and then you round off to 4 decimals, and the third and fourth should be multiple of 2, 5.
Oh.
Another.
If they are given in 2 decimals, we can calculate.
If the question, if it's only 2 decimal, you forget. You can work on 2 decimal itself. That's all. But on multiplication, sometimes it may gives to 4 decimal also. Then you have to round it off. If it is an Indian rupee, remember, rounding off has to be done only when the rate is expressed in Indian rupee. Understand? See, look, in this question, Euro, USD, nowhere there is Indian rupee. So no question of rounding off. What all answer you are getting, you write in 4 decimal. There is no question of rounding off. Whereas in this question, it is Indian rupees there, and you can round off. Here also Indian rupees there, you can round off. Now there can be another question. See, what is the forward points or forward differential? If the spot rate, interest rate differential, and forward period is given, there is a very simple formula. The forward points is equal to spot rate into forward period into interest rate differential divided by 360 into 100 or 12 into 100. When do we use 360? When the forward period is in days. When we use 12? When the forward period is given in months. Here the question is, for spot rate is 1.8. So applying the formula, it is 1.8 into interest rate differential 2%, 2 into forward period 90 days divided by 360 into 100. This will be the forward points. You will get 0.009. Yes. Sometimes instead of this forward points in days, they may give 2 months. Suppose the question is 2 months. Then how do you calculate? This will be 2, and here this will be replaced with 12. That's only change. And sometimes what is interest rate differential? Interest rate differential refers to, suppose the currency is, you want the rate of USD INR. Then what is the rate? What is the interest rate for in USA? 3-month interest rate in USA, say 3%. And the 3-month interest rate in India, say 5%. What is the interest rate differential? 5 minus 3, 2%. Such questions also they may ask. In US, the interest rate is 3%. In India, the interest rate is 5% for 3 months period or 2 months period. So the differential means the difference between the 2 rates that you have to calculate. And next question. This is the one you have raised. Given spot rates and forward points, 2-month forward GBP can be purchased at what rate? This is the question. That means who has to purchase? 2 months GBP can be purchased at what rate? The customer can purchase. So when the customer can purchase means for the bank, what is the transaction?
Selling transaction.
The selling transaction. So that means you have to calculate 2-month forward selling rate for the bank. Second question.
If nothing is mentioned, then we have to take that is being done by the customer.
Yes. See, can be purchased by the bank if it is there, means the bank is purchased. Or sold by the bank means the bank is selling. Here, can be purchased at what rate means the customer is purchasing. So 2-month forward GBP can be purchased at what rate is the question. So here, the forward points is 1 month 20-25, 2 month 45-50, 3 month 70-75. What is the forward points? Is it ascending or descending? 20-25. Yes, it is in ascending. So the currency is at a premium. So that you fix. So here the currency is at a premium, no doubt, because it is in ascending order. Now we want 2-month forward purchase. That means it is 2-month forward sale by bank. Am I correct? Forward purchase means it is 2-month forward sale by bank. And 2-month forward sale by bank, you take the spot selling rate. What is the spot selling rate?
1.2355.
1.2355. Now, currency is at a premium. We want 2-month selling rate. 2-month selling rate means if the currency is at a premium and the transaction is a transaction, you have to account up to that month. So 2 months you have to take. What is 2 months? 45.50. And what is for selling? Selling, it is 50. Am I correct? The first is the buying point, second is the selling points. Here, the 45 is the buying points and the 50 is the selling points. Here it is selling, so you have to take 50. Now remember, this 50, nowhere it is mentioned paise. That means you have to calculate, you have to convert it to 4 decimal. Got it? So you have to add 5042. 1.2405. Second question, 3-month forward GBP can be sold. So this is 3-month selling rate for the customer, and for the bank, it is 3-month buying rate. And 3-month buying rate, you have to take spot buying rate. What is spot buying rate? 1.2350. You add when the currency is at a premium and it is a buying transaction for 3 months, you have to take only 2 months up to the previous month. And what is 2-month selling transaction? What is 3-month buying rate? What is buying rate for 3 months?
0.0045.
0045. Yes, 0.0045. You add 9532, 1.2395.
Sir, only for buying rate we are taking up to previous one, no?
No. Here there are 2 things. I'll put it in another way. You're getting 1 second. See here, what is the principle? We are following in India. We are following the direct quotation. And direct quotation, what is the principle or maxim? Buy low, sell high. Am I correct? Buy low, sell high. We buy.
One more question. Can you explain that again? The premium and discount, descending and ascending. Along with this, now you're explaining this. So if you, I mean, just that way.
See,
remain discounting. How you're getting discounting and how you're taking buying
points. The forward points 2025. That means the first is the buying points and second is the selling points. Now this is 2025 means this is increasing, no? From buying is 20, 25 is more than 20. So that means this is in ascending order. Ascending order means the currency is at a premium. Suppose this is 2015. That means it is in descending. It is in descending means the currency is at a discount. That is 1 point.
Okay.
Now, next is when a currency is premium, spot rate is 75 rupees and 1 month it is 76. That means on a future rate, the currency is costly. Let's say we call the currency is at a premium. Suppose the spot rate 75 and 1 month rate it is 74. That means the future rate is cheaper. Means the currency is at a discount. That is discount. Okay. Now here look at.
Sir.
In this case, we want 2-month GBP can be purchased. That means we want 2-month selling rate. Suppose you take the spot selling. Spot selling is 1.2350. If you give 2-month, what is 2-month selling is 50.0050. You will get how much? 0.04. 1.2400. Isn't it? 2-month selling rate. Suppose,
sir, one doubt, sir. If it is not mentioned any customer, then it will be in the view of bank only. It has to be considered, no?
No, you have to look at the question. Here it is, see, 2-month forward GBP can be purchased at what rate? That is the question. So 2-month GBP can be purchased at what rate means the customer, at what rate the customer can purchase it. Otherwise, the question will be 2 months GBP can be purchased by bank at what rate? The previous question is, you look, it is purchase by bank, sale by bank. Here, by bank is not given. That means it can be purchased. It means the customer wanted to purchase. Customer wanted to buy from the bank means it is a selling for the bank. So bank will apply the selling. That's all.
Okay, sir. Got it, sir. Thank you.
Okay. So, sir, rate is premium. I mean, forward rate is premium, so we have to add it. And when rate is discount, we have to less it.
Right, exactly.
That's correct, right, sir? So, the 1 month forward point 2025, had it been 25-20, it's a reverse side, suppose 25-20. Okay. So, we would have less it, right? 1.2350
you have
minus.
to subtract. You have to deduct the
1.2350 minus.
Yes,
yeah.
Yes. That's all.
And when that you take, sir, buying buy rate of and sale rate with this one, buy rate of the buying rate of the one forward and selling rate of other currency, that something you had shown, no? So that something was
buying rate. The first rate is the buying rate. Here, look, the GBP USD 1.235055 means the first rate is the buying rate, second is the selling rate.
So sir is asking why are you taking this 1.2350 from buying rate and 0.0050 from selling rate? Why you have compared these two? That's why his question is about.
No, not that question. No, not that question. I think earlier slide it was showing that. Can you go to the grid, sir? They were showing that discount and selling and buying of rate selling. I mean the that PPT. PPT. I'll just PDF. PPT where you have shown that chart differentiation. I mean.
Cross rate mechanism or this one?
Then other one, I guess. This one, sir. This one. The previous one. Where you shown, na? Yeah, this one. So just which you can confirm SR selling rate. No, the where you annotated, where you have shown us. Where you have shown us that the previous slide, sir.
1 second.
Previous slide. Yeah.
This one.
No, sir. The example you showed, no? Example you showed.
Example is 1 second.
Example, the BR, SRI.
Sir, he is asking about cross rate.
This one, sir.
Cross rate.
SR and BR. SR. Yeah. SR and BR.
SR means the selling rate.
No, the last. Yeah, that I understood, sir. But have you taken the bank? I mean, buying rate and divided by selling rate.
When the common currency is on the same side, to get the buying rate, the rule is numerator buying rate, denominator selling rate. That is the thumb rule. You have to, for the examination point of view, you have to understand in that way only. How it is given means, otherwise you will not get. If you divide buying rate of 1 with buying rate of 2, the answer is wrong. That is what, because here it is the common currency is on the same side, or you have to change this to the other type. That means in the first situation, you have to convert it to a common currency on the opposite side by reciprocating it. If you reciprocate it, then this also you have to reciprocate. And here when you reciprocate, the buying should come to the selling and selling should come to the buying. That is the case. Suppose, see here, this not required for you at this moment. For your BFM CAB, it is required. This is only Jaiib, not required. See, suppose from USD SGD, if you are able to write SGD USD, then it is fine. If you want from this, how do you get SGD USD? By reciprocating. And when you reciprocate, the selling rate will come here, 1 by 1.26, and here 1 by 1.25, like that. The reverse of the buying rate will come as the selling rate, and the reciprocal of the selling rate will come as the buying rate. then you can
Okay.
use the first situation. Okay. Now
Okay.
you just
So here you have to take a cross rate, buying rate divided by selling rate only.
Yes.
Yes. Thank you, sir.
That's what I have given division of opposite side.
Yeah, both.
I think
Thank you, sir.
we'll break it. It's already now 11 o'clock.
സർ ഒരു ഡൗട്ട് കൂടെ ഉണ്ട്. സർ ലാസ്റ്റ് സൺഡേ മറ്റേ ബാബു സാറിന്റെ ഒരു ക്ലാസ് ഉണ്ടായിരുന്നു. അതിനകത്ത് ക്വസ്റ്റ്യൻ ഭയങ്കര കൺഫ്യൂസിംഗ് ആയിരുന്നു ഈ ഫോറിൻ എക്സ്ചേഞ്ചിനെ കുറിച്ചാണ്. അപ്പൊ അത് ഞാനൊന്ന് പറയാതെ spot euro equal to USD 1.3200/10. One
second. Tell me. Spot euro
equal to USD 1.3200/10.
200/10.
അതെ. Next 1 month forward point equal to 40/35.
Okay.
Find the rate at which 1 month euro can be sold for USD.
That means you want the selling rate of euro. That is the question.
അതെങ്ങനെ സാർ മനസ്സിലാക്കുന്നേ?
That is what. See, what is the spot rate euro is equal to USD 1.320010 means what is it? It is euro USD is 1.3200 1.3210. This is what? See, when a rate is given like this, USD INR, what is the meaning? 74, 50, 60. What is the meaning of this? When USD INR 74, 50, 60 means you expand it. This, when you expand, this is 1 USD is equal to INR 74.50 buying and 1 USD is equal to INR 74.60 selling. This is what? See, USD INR, if a rate is given, USD INR is 74, 40, 60 means 74, 50, 60 means 1 USD is equal to Indian rupees 74. The first is the buying rate and second is the selling rate. Here 1.3200 and 10 means this is the buying rate. The second rate means the 00 is replaced with 10. So the second rate is 1.3210. This is the buying rate. Now
buying rate, selling rate for euro ano USD ano?
For euro USD. Euro USD means 1 euro is equal to how much USD? Here, what's the question? You want the selling rate of euro in terms of USD. That means 1 euro selling rate, how many USD? That's the question. Means you want the selling rate of euro USD. That's all. Why so much confusion?
Okay, sir.
And here 40-35, descending order. The currency is at a discount. So here euro USD, we want the selling rate. So the spot selling rate is 1.3210 and the selling point is 35. 35 means is it paise or points? It's not paise. So because no Indian rupee. So 0035. You subtract 5, isn't it?
Yes, sir.
1.3175. Am I correct?
Yes, sir.
1.3. Clear?
Sir, buying rate കുറയ്ക്കുക എന്ന് പറഞ്ഞാൽ അത് ഒരു കൺഫ്യൂഷൻ. അതായത് ബൈങ് റേറ്റ് മാത്രമാണോ? ഇപ്പൊ 3 month ഫോർവേഡ് ചോദിക്കുമ്പോൾ 2 monthsലെ ബൈങ് റേറ്റ് അത് മാത്രം ഒന്ന് പറയാം. അത് കൺഫ്യൂഷൻ ആണ്. കാരണം എന്താ, അന്ന് ബാബു സാർ ഇടയ്ക്ക് അന്നൊരു ക്ലാസ് ഈ പറഞ്ഞ പോലെ ഉണ്ടായിരുന്നു സൺഡേയില്. പക്ഷെ ആ 3 month ആണെങ്കിൽ 3 monthൽ തന്നെ കുറയ്ക്കുന്ന പോലെയാണ് പറഞ്ഞിരുന്നെന്ന് തോന്നുന്നു. അപ്പൊ അത്
നിങ്ങളുടെ അതായത് ആക്ച്വലി നമ്മുടെ മാക്മിലൻ ടെക്സ്റ്റിനകത്ത് നിങ്ങളുടെ ജെഐബിക്കകത്ത് അങ്ങനെ തന്നെയാണ്. ബട്ട് ദിസ് ഈസ് ദ കറക്റ്റ് പ്രൊസീജിയർ. അതായത് ഇതാണ് അതിന്റെ ഗൈഡ് ലൈൻ. വെൻ കറൻസി ഈസ് അറ്റ് എ പ്രീമിയം, റിമെമ്പർ വെൻ എ കറൻസി ഈസ് അറ്റ് എ പ്രീമിയം ആൻഡ് ഇറ്റ് ഈസ് എ ബൈയിങ് ട്രാൻസാക്ഷൻ, if it is a buying transaction, we pass on up to the previous month, and in a selling transaction up to the same month. And if the currency is at a discount, in a buying transaction, it is up to the same month. In a selling transaction, up to the previous month. This is the correct procedure because we follow the guideline buy low, sell high. That means when a currency is at a premium, see, now the spot is 75. 1 month it is 76. 2 month is suppose it is 77. So 2 month means if it is a buying transaction, 2 month is the delivery period, means any day during the second month they can come. The customer, suppose they enter into a forward contract. Suppose the contract say in month, instead of that, suppose the delivery period is July. That means either they can come on 1st July or they can come any day between 1st July to 31st July. So that's why if we pass on the entire month premium to the customer, in the buying transaction, the customer is benefited. That's why we pass on up to the previous month. Okay. But if the due date is exact, the delivery date is 10th July, that means you have to pass on the premium up to that date. That is the thing. So those things, it is not required for you. For your CAB, will be discussing those areas.
പ്രോബ്ലം വരുമ്പോഴേ ഇപ്പൊ നമ്മളങ്ങനെ ഇപ്പൊ ഈ പറഞ്ഞ പോലെ പ്രീവിയസ് മന്ത് വരെ വെച്ചിട്ടാണല്ലോ ഡിഡക്ട് ചെയ്യേണ്ടത് പ്രോബ്ലം?
Yes. As per the correct procedure is this: you look at the answer, and sometimes there will be one answer. That means the correct answer. Then you can mark it. You look previous month and same month you take, and suppose because your Macmillan text they have given same month only for both 2 month buying or selling, premium or discount, buying and selling, they have taken the 2 month as it is. But the correct procedure is this: when the currency is at a premium, for buying up to the previous month, selling up to the same month. And when the currency is at a discount, buying up to the previous month, currency at a discount, buying up to the same month and selling up to the previous month. Because the principle we follow is buy low, sell high. Okay.
ഇപ്പൊ ഇത് സാറേ അങ്ങനെ ബൈയിങ് പ്രീമിയത്തിലാണെങ്കിൽ ഒന്നോടൊന്ന് പറയാം സാർ. പ്രീമിയത്തിലാണെങ്കിൽ
the currency when the currency is at a premium, when the currency is at a premium and it is a buying transaction, then you have to pass on the premium up to the previous month, and in a selling transaction up to that month. Similarly, when a currency is at a discount, in a buying transaction up to that month, and selling transaction up to the previous month.
Sir, exactly indirect quotation ചോദിക്കോ?
Direct and indirect ചോദിക്കും. There will be a question. Direct quotation means 1 unit of foreign currency expressed in terms of Indian currency, domestic currency. Indirect quote means 1 unit of domestic currency expressed in terms of various units of foreign currency. One Indian
problem ചോദിക്കോ indirect inde?
No. Problem will be all direct quote only. All direct quote.
സാറേ ഒരു ഇത് ക്യാപിറ്റൽ ബജറ്റിങ്ങിനകത്തെ ഒരു പ്രോബ്ലം ഉണ്ടായിരുന്നു സാറിന് PPT തന്നെ. നമ്മൾ ആ നെറ്റ് പ്രോഫിറ്റ് ഇതെല്ലാം കുറച്ചെടുക്കുമല്ലോ, ക്യാഷ് ഫ്ലോ എടുത്തിട്ട് വി ആർ ടേക്കിംഗ് ദാറ്റ് നെറ്റ് പ്രോഫിറ്റ്. നോ, അതൊക്കെ ഈ ഡിപ്രീസിയേഷൻ ഉണ്ടെങ്കിൽ അത് ഡിപ്രീസിയേഷൻ അക്കൗണ്ട് ചെയ്ത് നമ്മൾ ആഡ് ചെയ്യുമല്ലോ ചെയ്തിരുന്നത്?
Yes. അതായത് when you take the cash flow other than accounting rate of return, for other than ARR, for all other it is taken the cash flow. So for that cash flow you have to add back the depreciation. Whereas if the question is on accounting rate of return, ARR, there you have to take the accounting profit where the depreciation is deducted.
But in one problem actually it is actually depreciation is added, sir, I think.
Added, yes. That means it is for NPV. Either it is for NPV or some other question. If it is for accounting rate of return, you need not add it because it is accounting profit is taken. Where that is the only method for which the depreciation is taken into account. For all other method, it is the cash flow, because in the case of depreciation, cash is not going out of the firm. Understand? Because we are making a book entry. Whereas in the case of other expenditure, cash is going out. So cash flow is not affected even though you account for depreciation. That's why other than accounting rate of return for all other, that means for payback or for NPV method or ENPV method, all the method you add back the profit because there it is cash flow.
But in one question it was like, sir, initial investment of a project with a lifespan of 5 years is 10 lakhs, the average value is 2 lakhs, and cash flow in cash inflows before depreciation and tax are given. That was the question. So then it is worked out as cash flow.
Okay, and what is the ultimately what you have to calculate? Compute?
Compute ARR as per initial investment method, average investment method.
Compute ARR. So if it is ARR method, then you need not add back depreciation. It is not there.
But here in this work, this is in that one of the PPTs that you are given, cash flow is written, then depreciation 1,60,000 is deducted, then minus cash flow minus depreciation net profit, then net profit, then tax is deducted at 20%, then net profit is calculated.
Let me. That is in some other question probably. Not able to come out from this. Just stuck. Okay. Capital budget. Yes.
Share ചെയ്യണോ സാറേ?
വേണ്ട ഇത് ഓപ്പൺ ആവുന്നുണ്ട്. 1 second.
Okay, sir.
You can stop that YouTube streaming. It's not required, no?